What's going on, guys? Welcome into another episode of Money Moves. As always, your host, Matty A, my co-host, Mr. Ryan Breedwell. We cover all things stocks, real estate investing, economics, politics, you name it. Anything that ties back to you making money or protecting your wealth building, we like to talk about it. If you're new to the show, subscribe. Check out millionairemindcast.com. We got all kinds of great stuff, tools, resources, calculators for all of you who are out there building wealth in. And of course, if you enjoy anything that we talk about, all we ask is you support by taking 60 seconds to leave a review, whatever platform you enjoy listening to this content on. It's the best way to continue to help support the show. That being said, we got lots. I know you're excited. Because there's lots of data coming out this week.
Yeah, earnings are starting to cool down, but then it switches and it goes right back to data.
Yep. And so this week, which we'll talk a little bit more about, we've got PPI tomorrow. We're recording this one day earlier than we normally do because I'm heading off to Mexico for my birthday. So thank you for being flexible there. The big 3-6, baby. I'm feeling... Marie said I'm still in my mid-20s, like 34, 35, 36. Mid-30s.
I hope I'm in my mid-20s by the time I'm 36. I'm on my way.
But some people are saying, hey, after 35 is your mid-30s, and then 36 onward is late 30s. So I'm going to just say I'm still in my mid-30s.
I would say that,
I'm sticking to that.
I think,
I like
to
that
me,
one.
you know when it becomes not mid? 38.
Yeah, that's what we said. 38, 39, 40, you're in your late.
I was just thinking about that. 38.
Yeah.
37 is still mid.
Yeah.
Because it's not. Because here's what I'll ask you. If I got a C on a test, did I get a B? Or did I get below average?
Real technical.
There we go.
I like it. I'll play in that gray area. But yes, very excited. We got lots of data coming out this week. PPI tomorrow, CPI on Wednesday, initial claims, continuing claims, housing starts, building permits, and one of your favorites that'll really show us how powerful or maybe dwindling of power that the consumer has is retail sales data, which obviously is going to showcase consumer spending. And that's all coming out on Thursday. What are you looking for, and what are you expecting this week?
I think what we'll have is, so we have PPI tomorrow. I think on PPI, we probably are going to have a slight increase. I think we should get around a 0.3 on headline and 0.0 on core should be the report. Those would be slight increases, and that's just due to oil prices being higher, which is, it's almost an acceptable raise if it's due to that, as long as other metrics are going down. CPI, though, we should have a flat, I think around 0.2 on core and 0.4 on headline, somewhere around those areas. So those are what we're looking for in those two spots.
Talk about real quick the difference between PPI and CPI for the average person when we're talking about those two metrics. Like, what's the difference in them, and how do they tie into what maybe the Fed is looking at?
So they're not necessarily like black and white spot on metrics, but if consumer price index, CPI, is a measure of the cost of inflationary pressures in certain areas on the consumer, the same can be said in the opposite. Producer price index is the more wholesale side, the production side, and how inflationary pressures are affecting them. Why are they relevant to know the two? Generally, if we have a very big spike in producer cost, they might, or in most cases do, pass that through to their consumer. So it can just indicate pricing changes in certain areas.
Got it. Now, reading this off, and this is just a definition off of Investopedia, which is, although both are published by the U.S. Bureau of Labor Statistics and both measure price changes for goods and services that track inflation, they differ importantly in the composition of their target sets of goods and services, as well as in the types of prices collected for those different goods and services.
AKA different inputs.
There you go.
Yeah, and you would expect that because consumers are spending money in areas that wholesale and production side are not. It's going to be more shipping, and the fuel cost is the big one for PPI.
Yep, and it says these differences exist between the two indexes are intended to reveal different aspects of economic activity. The PPI is often used to calculate real growth by adjusting revenue sources for inflation, and the CPI is often applied to calculate cost of living adjustments by adjusting revenue and expense sources. Based on those coming in. You're expecting beats on both of those?
I think PPI is going to be, essentially PPI is going to be up or flat, and we think CPI is going to be
Flat or down?
Yeah, on the ones that matter, which is core, which removes the more volatile components. So I think we're looking for a 0.2 on PPI and a 4 on CPI. I'll double check that for my reports real quick.
And now as you're pulling that up, we've got, initial claims, continuing claims, housing starts, building permits, retail sales data. What is the overall expectations around that coming out on Thursday after CPI? And let's assume your assumptions are correct.
0.2 PPI, 0.3 CPI core. That's what we're hoping and expecting, or flat.
Okay. And then the data coming out on Thursday, what's that going to tell us? And if it aligns with what you think is going to come out on CPI on Wednesday, what do we think the Fed is going to respond with?
So the Fed already essentially said that they're not really looking at hikes, which is good because that rumor started floating around, which I thought was weird. I just think it had been so long that people had been getting pauses. They're saying we haven't got an indication on the downside. Maybe they're looking at the upside, and they cleared the air on that. If we get the reports in the way that I'm expecting, I think it would indicate to the Fed that we're continuing on that trajectory down. And I would say like the overall consensus of economists right now we're still trending down. We're just not trending down at what consensus was maybe end of Q3, Q4 of 2023, and even Q1, like the month of January of this year. So although we're trending down still based upon if those reports come in like I'm expecting, I think that we would want to see a quicker downtrend, and that would get us 2 cuts faster. Still expecting 2 cuts this year. Right now, that July, September zone is looking like the sweet spot.
Yeah, it looks like where the data shows we're looking at % pause and a 4% cut at the next meeting, 75% pause and 25% cut for July. And then it flips in September, 75% chance of a cut with a 25% pause for September.
If we did this show on like Thursday, those numbers would likely be completely different.
Yeah, because obviously there's so much data.
Correct.
That is going to skew those.
And I believe it would read more in the cumulative spread versus like the spot on spread. So what's the cumulative average leaning to? And I think what you would see is probably a huge any spare parts from the cut on the next meeting go over to the pause.
Yep.
And then what you might see is if we get really good inflationary data on these next 2 reports, we have to keep in mind that if we're going to lean on PCE and die on that hill, we also have to remember that although these could be really good PPI and CPI reports, they are no longer the main metric. They're just like an outside rail or a guide that the Fed is keeping track on. So trying to be fair on that, because I've been making sure people have been keeping that in line. But if they are, I think that the market will rally. Bond yields will continue to put pressure on them, so bonds should rally. And we should get more dovish tones from the Fed unless something, again, happens outside. And I don't know what kind of data points we would have between now and then, because PCE obviously would come out. So if PCE comes out whack, that could throw it off. But we have another payrolls report. I don't think that's going to spook anything. And I think we have average hourly work week. And so we want to see in the next 60 days unemployment get to above 4% if we can. That would make the Fed happy. And we want to see these reports that are coming out like PPI and CPI either be in line or still be moderately ticking forward. I would love to get a shock on the downside, and that would almost be like, hey, we're caught up now.
Yeah.
We're par with where we want to be. But the general the general good news is we're still trending down. I think the thing that is just making it hard to hold the reins right now is we're not going down as fast as people want it to, and we're getting closer and closer to the election day, which tends to bake more volatility in the market because people don't know what's going to happen from a legislative standpoint.
Yeah, it makes sense. Now, talking about how important is government spending tying into this whole equation, and I'll just give you a little context to why I'm asking this. I don't know who Piper Sandler is, but I was...
They're a good analyst. They're a good analyst. They're bullish.
Is this an individual or an organization?
No, org. Yeah.
It's an org.
Yep.
Okay. Piper Sandler said U.S. federal spending is the biggest threat to disinflation and lower interest rates. high government spending is measurably supporting GDP and keeping inflation sticky, depressing incomes and living standards while lifting the poverty rate, which kind of feels like a pretty accurate statement based on the fact that we've got insane amounts of government spending right now, which is obviously supporting GDP remain relatively healthy and positive, or could be a factor in that remaining, because I pulled up this graph as well. 13 countries have seen at least 2 straight quarters of per capita contraction per Bloomberg. And this was Q3 of 2023 and Q4 of 2023. Obviously, I'm not looking at a graph that shows Q1 or soon to be Q2, but there's a significant amount of these countries that are in what would be considered a technical recession, right?
They have to be full quarters of negative GDP. So are they negative, or are they contracting from where, is it saying it's pulling back 0.1 from a 0.3?
That's a good question.
Yeah, I don't think that there's many.
At least 2 straight quarters of per capita contraction. So that might be more aligned with what you're saying.
Yeah, no, that contraction is not a negative. It could lead to a negative report.
Sure.
But I think what that's meaning is the economies are slowing down. But Europe is ahead of us as far as getting a handle closer to their 2% number. And so we are probably leading, we are leading towards that right now. We're so close to 2. And if you look at some of the graphs we were talking about earlier that indicated that we're right near 2021, right after inflation started spiking. So we're almost back to baseline where we were prior to inflation kind of getting a little whack and out of control.
So then with this statement of kind of high government spending,
I think that's I don't think that I agree with that as much as that I think that's implying that government spending is supporting GDP as much as it is. I think that government spending right now is actually not supporting GDP because the money's being sent to areas that has no impact on when we spend money in a different country, that has no impact on our gross domestic product.
Yeah.
So I think I agree that government spending is a threat, but I don't think it's because when it goes away, GDP is going to flatten out. I think that if we were to tighten up areas of government spending and focus it in areas where it matters and allow domestic energy production to grow, I think that would be a really big key to our GDP.
Now, and we talked about, you sent me this graph earlier on January consumer spending and inflation. And according to this data, right, inflation has not stopped going down the whole year.
Yep.
Based on what we might see come out this week with consumer spending and retail sales. Should those be somewhat tracking together based on this graph and what we've been seeing historically?
I think if consumer spending is strong, what that's an indication of is that the consumer is strong, consumer strength, because we need consumers to spend for that to pass through into the economy. I don't think they're necessarily as tied to that specific graph. Mm-hmm. That graph is just showing us that the components of the indexes that those are looking at are tracking downward or in the right direction.
Yeah.
Core, I believe, is lagging headline, or is headline lagging core? I can't remember on that one.
Core is lagging ahead of PCE.
Okay, yeah. So PCE peaked out sometime mid-2022, and actually we had a drop and then a re-pop up, and fairly soon after that, almost towards the end of 2022 is when, CPI, core PCE. No, what I'm saying? Yeah, core PCE peaked out. So what we want to keep in mind is if we see a huge spike, and that is an issue, which is why if you look at that graph at the beginning or the end of last year, people started worrying because we saw the PCE price kind of starting to go up. But that's why they remove some of the more volatile segments of it, and you can see cores on a steady trend down.
Yeah.
That's why I keep saying when people are like, oh, recession, oh, this, oh, that, the hard data doesn't line up with that. And that's hard data, not soft as some of the other data points that people are pointing to. So I think that is going to continue to trend that way. And if it does, we're mere months away, because if you look to where that goes to, 2021, we're pretty darn close to where that baseline starts.
Yeah, it is. You're right. We're getting pretty darn close to getting back to where we were in 2021. Now, based on what you're seeing in the market, Are there any repositionings that you guys are doing right now? Any shift towards certain sectors based on some of these trends that are the hard data is now supporting and showing?
Yeah, we got a little way to go for some of our clients. We went a little more heavily or overweight in financials. We got really underweight healthcare, and we also looked at some communication names and also made some positioning into that sector. I think on the individual side, some of the stuff that we were looking at is names like Oracle and things like that. But as a whole, the communication sector, and then nothing particular in financials, just your tried and true big banks. I really like Truist Financial. I think they're like a really big regional, but they're a really old one. So they're like a big regional or a small big bank, however you want to look at it that way. So we just really like financials right now. We still think they have a long way to catch up. And when cuts do happen, which we should be now on the cusp of that, big banks are going to benefit a ton, because even though the cost of money or the profitability on money goes down, more people will ask for it. So the quantity of those products will go up. So origination fees, refinancement, and that's going to be huge, we think, for banks.
Now, I sent you a video from Patrick Bet David on 2.1 trillion in savings and kind of accessible cash that was in the market at the peak. I forget where that video was. Like, if it was it at 2021 or 2022 that was at the peak?
I think 2021, and it was bank savings.
Bank savings. And now that is dropped pretty significantly. Is the American consumer losing steam? Is this foreshadowing us heading towards a winter, or is there more to that than what meets the eye?
I think the latter, more to that than meets the eye. So when we have conflicting data points that happen, that means there's something in the middle that we're not seeing, and we have to learn to read between the lines. So if consumer savings was going down, even though overall U.S. credit card debt is up, that'll always continue because cost of goods go up, so people are going to spend more on the same goods. It's still higher than it needs to be right now, but consumer debt we saw is pretty low. If we have savings continuing to deplete, or in case of the graph that he's referencing, in a negative territory, we wouldn't see the consumer spending as strong as they are. And so when we have a conflicting data point, we have to look and find somewhere in the weeds where we could get an answer for that. And what I found and what I sent to you is the graph that shows the depletion of savings deposits at the same time with the almost on par flip-flop, indicating that 75% of the money that went out of bank savings went into money market funds. And so you actually just see almost an absolute flip to where we have this huge deposit and now huge base sitting in these money market funds, and we have a lower amount sitting in almost where we started on money market accounts, sitting in bank savings now. And I think the biggest reason is because traditional savings accounts still don't pay yield. People have to sign up or indicate they want to, hey, I want a high yield savings account, or hey, I want a CD product. Money market funds, the yield just moves in lockstep with normally a 7-day like overall interest rates. So most money market funds right now with no minimums pay somewhere between 4 to up to 5.2%. I've seen higher rates than that, but I'm just going off of what I've seen recently. And the funds are fairly liquid. They're held in a mutual fund or an ETF on the money market side versus held in cash and then put in instruments by the bank that's backing that. To me, what it indicates is people just move their money to places where their money was going to work for them, because eventually people, the news was talking about money market funds. People found out about it and they just started putting their money there.
Makes sense. Now, there's been some stuff heating up in the market over the last 24 hours.
Oh, yeah.
It feels like the Reddit retail
back. The apes.
Recap is happening all over again. GameStop at a peak today was up 110%. Trading had been halted for a 5th time from, essentially you're saying that's the way that they prevent a melt up in a stock.
Because they do it on the downside. They have to do a part of the upside. They don't allow stocks to pump.
Yeah.
So it was halted multiple times. Being halted once is a big deal. Being halted 5, 6, 7 times is huge.
It closed up 74% despite being halted 9 times today.
It's quite a bit.
How does this happen? Like, to the person that doesn't understand Like, how do you wake up on a Monday morning and something like this just takes off?
In this case, it was a prominent, the person that did it last time, who now has eyes on him, who put a meme out. And I don't know how you read that meme, because I looked at it and I'm like, man, that doesn't say a ton to me. But the people in that community caught what it was, and they just start quite literally dumping their life savings into these, because it's investing, but ultimately it's more of a fun game, and they really just want to stick it to whoever the man is or the woman. And that's my opinion. I think what I was saying to you is, when it starts getting this much attention and the stock starts moving up that much, big short sellers are going to start going in and probably taking large short positions, which will push the price even higher. And so we're going to get, I think, even more of a squeeze if this goes the way that I think it's going to go. And then we're going to see how much the consumer can hold out with less money in excess savings.
Right.
Versus, their money market accounts. Will they give up yield to gamble? I would argue that people with excess money in money market accounts probably won't. I don't think so. Yeah. I think those are smarter investors, people that look for their money to work for them. I think people with the money that left their money in the banks, yes, those people might. And the way that it happens is people, little $100, $200, $5,000 transactions, if they're on the buy side, they start adding up. And then there's people that are shorting that stock at that level that weren't expecting that. So they're going to either have to cover their short, or they're going to have to buy out or sell out. And then that person makes the short seller loses, and the person that let him borrow the stock doesn't. But I don't think that anybody should get involved in it, because it's almost like one of those things when you've missed the train.
I'm going to say, once you're reading or hearing this, now's probably, and this would just be my opinion, I'm not giving financial advice and not the guy to do it on this side of the street, but you already missed the boat.
100%. Or at least I'm going to guess that. Now watch. It's going to go up parabolically, I guarantee you, now that we said that. But it's just it's too volatile, and most people don't have the wherewithal to either put stop losses in, or to say, hey, you know what? I made 100%. I doubled my money in a day.
Yeah.
I'm not going to be greedy.
Yeah.
Or I'm at least going to sell most of it, and then I'll let some ride.
Yeah.
Just to see, hey, I made all my money back. I made 70%. I'm going to let my 30% profit ride. And then if that doubles, you sell it and do it again. But you be prudent, because it's just a number on a piece of paper until you realize it.
Yeah. So true.
Yeah.
This GME trader got $25 call contracts that expired on May 17th. To an average of 21 cents. He bought those for he put in $27,000 behind it. They peaked at $13.63, and assuming that he stayed in, this is a 6,400% return, turning $27,000 into over $2 million.
You've almost have to ask yourself,
how is that even possible?
Yeah,
especially before this meme stock got released and blew up.
Yeah.
How is that possible, and why would you do? It's
like
so weird.
Well, I don't feel like I know statistically is likely to
trading.
Hit like a jackpot in a casino on a slot machine than making that kind of call. But it could. Let's say that it was clean. Let's say that person genuinely said, you know what, I think on this day this is going to happen. One of the best calls of the year.
Yeah. Shit.
But I would have no idea how you'd have any insight, because what set it off is, if I saw that, I would just scroll past.
Right.
I would have no idea what that is.
Yeah. Yeah, the fact that meme from that particular account was spotlighted, and his influence in that particular space of the trading world triggered people to start dumping money into the stock.
Makes
and
no
doing what
sense.
it did as fast as it did. It just, again, is another example of how powerful social media is nowadays, and how social media has changed the game in so many different industries in so many different ways.
Yep, and it's made it to where if you have an influence over people, right or wrong, you can move the needle.
Yeah, 100%. AMC closed up 78% today. Similar type of story.
Yeah, even actually worse, because their market cap is 1 point some odd billion, and GameStop at least has brick and mortar, so they almost are a $10 billion company.
Now, you talked about looking at the overall charts of value here. It sounds sexy right now based on the percentages that we're reading off, but how far off are these from stock highs?
Bigly.
Bigly.
A lot. Like, not even close. I mean, it literally
Oh my gosh! Wow, yeah,
Yeah,
I mean,
so-
you guys can't see, but we're looking at a chart right now. Of where
We're
it's at
talking
today, peaked out versus where it was.
AMC
Peaked
was
out
in the 50s, so it
during
looked,
the pandemic.
Yeah, it looks like the end of a staircase, and then just the ground moving out there. And then let me see where GME was, but it's going to be the exact same story. It is. Let me see. Let me go farther out on the monthly. There we go. Quite far down.
Oh wow!
So we're talking into the hundreds, and now it's trading at 30. So these are all way off their highs. And by the way, they got to their highs by short squeezes.
Mm-hmm.
So it wasn't from fundamentals. It wasn't from financials. So ultimately, given a huge injection from some investor, I don't see how the stock price could stay there because and people have to keep buying it and keep buying it and keep buying it for the stock price to go up, and eventually people are going to run out of money.
Yeah, makes sense.
Yep.
Talking about a company that is not a meme stock, that is having some great uptick since we last chatted about it last week. Rivian is up 20% over the course of the last week. Why? What's going on there? Anything that you're paying attention to on that stock?
Here's my guess. Right now, the tariff cost to import Chinese EVs, so non-domestically produced electric vehicles, is at 25%. And I believe there is a bill pending with a high likelihood of passing, or it's already passed and just needs to get signed, that increases that tariff to 100%. And so that juices, I believe Tesla was up over 1% today. I think that Rivian was up 10% today on the news. And then I think if the weird thing is, if you looked at the Chinese EV makers, they were up today, but I think it's because if that tariff goes into place, the Chinese government will likely do something to spur growth into those companies so then their domestic growth continues to happen. So that's my guess. Rivian has the most upside potential as far as from a beta, in my opinion, not investment advice, but right now they're trading at a much lower stock price. They're not in headlines for any negative stuff. They don't have an Elon Musk, which is a positive sometimes and a negative others. They're really focused on just producing cars. They still have over, I believe, $2.1 billion in like investor cash to spend.
Yep.
And like I mentioned, the reason that I was interested in them is just because they have a full-size model coming out this fall. I think that's or a bigger car coming out this fall. I think it's going to attract more people to buy them. And then they have a mid-size car coming out next year. So they have a pipeline, and it reminds me a lot of Tesla before Tesla blew up, even when they were on their good run. And I don't own a ton of Rivian stock. I personally own none. But I just thought that it had good potential upside. And sure enough, since we've been talking about it, it's gone up about 20%.
That's great. Now, I know there's still a couple other big players reporting earnings, I think, this week and next week. Which ones are you paying attention to? And ultimately, why are you tracking those? What are those going to tell you?
This week, just Walmart and Home Depot, mainly those two because they're reporting this week, and they're huge retailers. But beyond that, Home Depot is a unique one because it shows the kind of strength of the medium to small size construction business, which is very important, but it also gives an indication on the retail consumer. Walmart, obviously, because now they have their online presence and their in-store presence, they can give us some idea of foot traffic in the store, what consumers are buying, are they returning items, and if their sales growth year over year has been better or worse, and they'll give us some guidance. So I think that will give us an overall health of the consumer from both ways, because when retail consumers spend at a place like Home Depot, it's generally excess money, home projects, backyard stuff. But the weather is also lining up to indicate that's probably going to be in the report, because this is the time of year when people do that kind of stuff anyway after bad weather. So none of them are going to be, at the end of the day, game changers for the market as a whole. But if they're positive, it's just an addition to the good catalyst that I think we've had so far this year from an earnings side.
Shifting over to a little bit of real estate, nothing too exciting to report. NAR's got a lot of data coming out on commercial and single family right now, basically making their assessments, their predictions, analyzing a lot of the data that's coming out through more of the macro channels. Their housing affordability index noted that housing affordability weakened nationally in March compared to the previous month. The monthly mortgage payment increased by 2.8%, while the median house price increased by 2.4%. Inventory as of this week continues to grow a little bit. Inventory is up 1.6% week over week, up 35% year over year. And this is still down it's down 36.6% compared to the same week in 2019. That kind of continues to be the point that we always go back to as the most normal levels of inventory pre-pandemic. Donald Trump. Inventory is now up 15.2% from the February bottom and almost above the maximum for inventory last year. So it'll be interesting to see how that kind of plays out throughout the summer.
I didn't see that.
And seasonality. Back in June of 2023, inventory was down almost 54% compared to where we see it today, the 36.6%. Yep.
Okay. Wow, okay. So we haven't even been a year since we bottomed. We're about 1 month away.
Yeah. With rates still where they're at, still a lot of people sitting on the sidelines. They feel like it's too high. You made a mention to the historical averages of rates, and I thought it was a really interesting point how you framed that.
I was just taking a peek at mortgage averages and noting that since they started tracking the data, which I believe was in the 50s or 60s, to date, the average mortgage payment would be around, or interest rate would be around 6.5%, so north of 6.
It was close to 7, yeah.
Yep. And the same data point taken from 2003 to now was about 3.4, I believe. And so what I was thinking of is, okay, who are the people that are buying? It's the generation right after us and our generation. So anybody who's been a real estate investor or purchased their home, and I'm not pissing in your Wheaties here, I'm just giving you the facts as they are, has been working with debt and debt instruments at a rate that has not been seen over the course of history.
Yeah. Yep.
Is 50% lower, if we're looking at those two ranges, than normal. So I think what that tells us is, and what I keep stressing to people, is that when they start cutting interest rates, I think people have, or some people have it in their mind that, okay, great, I'm going to be able to go back and pull the same spreads I was pulling 4 years ago, or same spreads I've been pulling. And I don't think that's going to happen.
I agree.
I think there's going to be a big push now in operator quality and amenities at certain multifamily assets like apartment buildings.
Oh, yeah.
I think that's going to now be the focus because there's going to be a much tighter spread on how much profit is the drive there. So the way to add to that, I believe, is value adds, intangible value adds or tangible value adds. And I think that's going to boil down the people that can work in that space, especially on the commercial side. Flipping that on its head, NAR's lawsuit that they got in, and I think they made I don't know if they lost or they made it's
still in court.
But with the commissions thing.
Yeah.
So now people have their eyes on commissions. So now they're going to be paying even less. So all that kind of stuff bakes into it to where I think that it's going to come down to operators. And I think the people that are picking real estate moving forward are going to have to learn how to operate an asset and generate profit off an asset at double or triple the interest rate that they've been working with prior. And I don't know if a lot of people can do that.
The answer is no, not a lot can do that. And you look at the cost of insurance and where insurance has gone up.
I didn't even consider
You have the
that.
cost of capital, operating expenses between energy costs and insurance costs. Those being two things, obviously taxes up and down depending on different variables and levers in that equation. But then you've got obviously cost of capital, right? The velocity at which deals have been getting done is significantly shrunk because of those reasons. And when you look at now banks scrutinizing who they're giving that debt to, like you said, they're going, yeah, you might have a phenomenal deal on paper, but operating capacity and sponsor balance sheet strength and your history and your chops for operating in these spaces, they've really tightened up. 2 years ago, you could be a doctor and go to a bank and get a $40 million loan for an apartment building because you were able to raise the sponsor equity. And the times were just so different with how expansive and open the capital markets were. And they are so drastically different today And that's just the cost of capital variable. You layer in now many of these operating expenses that have drastically changed as well, with insurances, with taxes, with all of these other things, energy costs. These are things that now, as margins thin even further, you see a lot less deals happening, a lot less loans getting done. And that's going to be something that'll be I think this is going to be a season where there will be phenomenal opportunities for the great operators.
I agree.
For the people who understand how to mitigate risk around those variables in this new equation, and also understanding that the market will swing back at some point.
Yep. I just don't think we're ever going to get to interest rates that low again.
If we did, I would love that.
Yeah, I just don't think we are.
There's so many people that when you think I got 2 commercial buildings that have 3.65 on them, and I'm like, oh man, and they're going to reset in 5 years. So I got a couple years left on them, but I'm like, man, if I could have locked those in for 20 years.
And that's where I think what's going to eventually happen is smart investors or smart buyers will realize that, and sellers, and they'll move on and stop playing the timing game.
Yes.
And I preach the same thing on my side of the street, and it's the same thing on yours. It's people trying to time the market, and they always look back with 20/20 hindsight saying, man, when the dust settled, I still would have been better if I just would have. I should have just done that, because now I spent all this money over that period of time. I have nothing to show for it. Oh, and now the asset's more expensive. Oh, the market's back where it was and then some.
Yeah.
I missed the boat. Okay, when do I do it again? And then they just get into this analysis paralysis. They never make the right decision. And thank God for those people. Soft hands. Lotion has made me a lot of money in my career. Soft-handed people that sell and on my side of the street give me good deals for my clients. People that get scared and make knee-jerk decisions on your side of the street do the same thing for you.
Yeah, good market, bad market, slow market, fast market. There's always great deals to be had
somewhere, man.
You just got to be very intentional about when the stakes are high and margins are thin, right? You just got to operate with even that much more discipline and diligence.
Yep.
When you have a market that you have a little bit more freedom and flexibility, and it's a little more forgiving, maybe you get a little bit more aggressive.
Agreed.
But ultimately, you got to understand where you're at in the economic cycle. You got to understand the core variables of what drive cycles, what drive capital, what drive risk, and how you mitigate it. And we're in one of those cycles right now where there's a lot of variables that make it challenging. So you got to be skilled. You got to be leaning in and really doing your due diligence to make sure that, because if you can make it through these seasons, get out on the other side, not only are you going to look amazing, but you're going to be able to have now a new level and a new basis that you're going to be playing from that really crippled a lot of people. I can't tell you how many people I've talked to over my investing career. I was worth $100 million, and then 2008 wiped me out, right?
Oh, and I've heard that story forever.
I'm this person, and I got wiped out doing this and that, and it's like it becomes a part of their identity. And it's if they would have just done a few things where they checked their ego at the door, they didn't over leverage themselves, they didn't allow their ego to drive certain decisions, and they made it through that, they'd be worth probably $200 or $300 million now instead of $2.
Same. Mine is people that buy stuff and then they sell it, and I'm like, what are you doing?
Yeah. So
because if you would have held, we would have been fine. Just hold.
Yeah.
Don't be scared. Scared money doesn't make money.
Well, that's why
long money does.
That's why I'm always constantly reminded when I'm around people that are stupid wealthy. It's all the regrets were never the things they didn't buy. It was the stuff that they sold.
They got rid of.
Right. And I look back at my investing journey, and there's probably 3 or 4 properties that I wish I would have held, and I didn't. And those were great lessons that I learned. But that's when you think about investing, you're rewarded by time in the market, time in the asset, and just allowing it to compound and to do what it does. Now, there's obviously different ways you can work those equations and you can play.
But the formula remains the same. Inputs are different, same parts.
Yeah.
It's pretty crazy.
Yep.
It's like cars, man.
Yeah, so true. I figure I was like seeing a little bit more of the data that rolls out on big, expensive properties that are selling for pennies on the dollar. This week, the Pinnacle Bank of Texas bought back the 40-story Burnett Plaza building, which is Dallas-Fort Worth's tallest building, for $12.3 million at a recent foreclosure auction. This was just $12 per square foot and less than 1% of its previous sale price. That is the cheapest. That's 1 penny on the dollar.
That's the cheapest it's ever been.
That's the one.
Because
that's the cheapest one that I've seen.
They
get
sold the asset too, didn't they?
Yeah.
For a couple $100 million.
Oh yeah. Yeah.
Oh man. And they're like, hey, we're gonna do it again.
Yep.
Rinse and repeat, folks, on the same asset we already did it on.
Crazy, right?
That's crazy.
Yeah, they were the bank. They were the debt holder on it.
Oh wow. Oh,
So-
that's beautiful.
Yeah, that is capitalist finest right there.
That is.
We thank you guys for tuning in today. Until next week, don't forget, if you enjoy the show, leave a review. Check out millionaireMindcast.com in the store. A lot of great stuff. We got some updates going on in there for you as well. If you enjoy this show, share it with a friend, a family member, somebody that you think can participate, get value by being involved in these kind of conversations. And until next week, keep investing in yourself and your wealth on your march to $1 million and beyond. We'll see you guys then.
Cheers, y'all.